Welcome to Morning Call. I'm Latha Venkatesh. With me are Sonia, Shenoy and Anuj Singhal. The markets seem to be preparing for a second day of discounting the Yuan devaluation. India will be the test case because yesterday, it was about half an hour before our trading started, or an hour before our trading started, that the devaluation news hit global markets. This was the first major economy to react, and while we put up a brave face for the first half, the capitulation or the sell-off, I would say not capitulation, really, the sell-off started in the latter half, and you could see that the reverberations of the Chinese yuan devaluation across the world. But today the world will have to take cognizance of one important question. Is this a one-off, or is this now going to be Chinese way of dealing with its economic growth? We will have to know from the way even the Indian markets react. So today really will be the test case on how the markets are sizing up this very important development on global markets.
Oh yes, indeed, and that has been, something that has spooked global markets in the last 24 hours, Latha. Even our own markets, there was a big sell figure from the FIIs, almost 737 crores in the cash market, so that won't go down well with the street. The Dow has seen a triple-digit cut. NYMEX has hit a 6-year low, so there was a massive slide that we saw in crude overnight as well. And there are a lot of brokerages who have put out notes. Credit Suisse, for example, says that the yuan devaluation will not spur a risk-off trade in equities, but of course it's a big negative for commodities, for companies that export to and compete against China. But this morning, as of 7 a.m. this morning, I understand that there was a verbal intervention by the People's Bank of China where they said that they don't intend to depreciate the yuan. What they did yesterday was just a small intermediate move. It's not the beginning of a larger move. So that is the one verbal intervention that came in by the People's Bank of China. Nevertheless, do you see this as a longer term impact on global markets?
Well, in the first place, let's just look at the impact on India. I want to put some history into this and pull up some data that I have collected. In any case, there has been a huge amount of Chinese goods that all countries are absorbing, and India is absorbing. For instance, in FY14, the Chinese imports into India totaled $309 billion. Last year, FY15, it was $369 billion. Now, that's not a small jump. That's a 20% jump in 1 year. And it wasn't as if Indian economy was growing in leaps and bounds last year. It clearly was because Chinese goods were being dumped or being sold at a lower price, which is why there is this huge increase in Indian imports from China. Likewise, you look at the April-June figures. So April-June for the current year is again another 15% jump over the previous quarter. 82 billion in April-June 2014. April-June 2015 is 93.3 billion. Now, contrary-wise, if you looked at the exports, you can clearly see that China, because of its lower growth or for whatever reason, is resisting Indian exports. In FY14, total exports from India was 90 billion. In FY15, it fell to 73 billion. Likewise, if you take the April-June quarters, it was 17 billion. It has fallen to 15 billion. So the trade deficit that India has with China is going to expand considerably. That is a moot point. It's not the trade deficit I'm worried about. It is just that Indian industry is losing out. They are not able to export and they are not able to sell to their own country. Indians are buying more Chinese goods than they are buying Indian goods, which is why you have this welter of increase or tidal wave of increase in Chinese imports into India. On this, you are going to add a devaluation. Okay, so now let's come to terms with the devaluation fact itself. For the longest time, all through the 90s and the 2000s, especially in the 2000s, IMF, the United States and developed countries were crowing and crying that China should allow market forces to determine the yuan. But the Chinese never allowed it. They kept the yuan cheap and bought up US Reserve because US was investing hugely. The entire manufacturing base from the United States was shifting to China, which means a whole inflow of dollars. And as of 2014, the total Chinese reserves had risen to over $3 trillion. That is the extent to which China bought up dollars so that the yuan did not get cheap. But from 2009-10 onwards, the yuan has been basically stable to appreciating. China allowed, because it wanted to marketize, to make the yuan more market friendly, it was allowing a gentle appreciation. It was not a rapid appreciation it was allowing, but a gentle appreciation. The last 1 year is a totally different story. There have been dollar outflows. No more investments in China. US companies and other foreign companies which were putting manufacturing bases were remitting huge dividends, were not putting any additional investments, FDI, into China as well. China, because it wants yuan to become market determined, was allowing a lot of its citizens to invest abroad. Very much like we Indians allow, our mutual funds to invest about 50 million abroad. A minor investment abroad. Even every individual can, increasingly move towards capital account convertibility. That happened in China as well. And for the last 1 year, around $350 billion of reserve drawdown has happened in China. Outflows from China. So today, if the yuan is left free, it will actually depreciate because outflows are more than inflows. Okay. So that is the big fear of the market. As China does what it has always been committing it will do, to move the yuan to a market-determined currency, at this juncture, it will actually depreciate the yuan. So, while this verbal intervention is very welcome, that this is not a wanton depreciation, what is it? It's 2%.
Yes.
You know how much India depreciated when there was that run on the rupee?
Yes.
It was a 15% depreciation. I mean, this is 2%. You really cannot complain against this.
Yeah.
If left to itself, chances are that the Chinese yuan will easily depreciate another 5% this year. The point is 5% itself doesn't make the economy so terribly uncompetitive. But going from the backdrop, we've already seen so much of Chinese dumping. On top of it, a further 5% or 7% cheaper Chinese good is going to mean that much less of Indian goods being consumed by Indians.
Yes.
Let us be very clear. Indians will buy more Chinese goods than they will buy Indian goods.
Yes.
So we have to be prepared for that.
Indeed, and that's what we saw yesterday. I mean, all of the tyre stocks, names like Apollo Tyres, MRF, JK Tyres were under quite a bit of pressure. But Anuj, morning, it's the big sell figure that really worries me. I mean, 730 crores. We haven't seen this kind of a sell figure from FIs in a while.
And this can't be a Chinese impact, isn't it? So, how do you come to terms with this number?
Yeah, my sense is that the Nifty is at the risk, the market rather, is at the risk of a major trend reversal. It started with not with yesterday's trade actually. It started with the Monday trade when market fell at 3 p.m. It was the third time the Nifty went to 8600, 8650 and reversed from there. This large FI selling number will spook sentiment. Even if we keep saying that this market is being driven by DII flows off late, but still a 700 crore FI sell number on a day when it was not matched as much by DII buying, only 130 crores, it's going to impact sentiment. And I think the texture of market selling yesterday was interesting because it was led by State Bank of India. State Bank of India alone had delivery-based selling of about 300 crores. So that's point number one, that a large stock like SBI led the market decline. It was also the biggest contributor on the way down. The other thing is, take a look at what happened with the index futures and options data. FIs net sold 850 crores in index futures, and in that it was quite interesting because there was unwinding of 17,000 long contracts and there was addition of 18,000 fresh shorts. And if you take a look at the data, the Nifty futures lost open interest, the Bank Nifty futures added open interest. Short point is that Nifty long futures positions were booked and on the Bank Nifty fresh short positions were added. You could say that, maybe the Nifty may still not be at the risk of a major fall. The Bank Nifty clearly is at the risk of revisiting the previous lows, maybe even 17,500 thereabouts, because that is where clearly there was massive shorting. For the Nifty, you still have the comfort that the Nifty is still not below 200-day moving average, and normally you take support there once or twice. Yesterday, for example, it took support there at 84.50. So that's something that maybe, keeps Nifty slightly protected. But for the Bank Nifty, I'm beginning to get worried, not just because of SBI, also because of ICICI Bank. It went to 320 thereabouts, and now it's back to risk, at the risk of slipping below 300 and going back to previous lows. And there also, we have seen delivery-based selling. Index options, again, quite a bit of index options buying, 1250 crores. And I was looking at the puts and calls data, buying of Nifty calls and buying of Bank Nifty puts. So all in all, the sense I got yesterday was that there was a bit of a pair trade going on towards the end, with the Nifty taking support at 200-day moving average, which is to buy the Nifty calls and buy the Bank Nifty puts. So the sense here is that the Bank Nifty clearly is at the risk of revisiting previous lows. For the Nifty, if it starts trading below 84.50 consistently, then the Nifty is also at the risk of going back towards at least 8,300, maybe even 8,200. That's at least the risk as we start trade. If the Nifty takes support at 84.50 or 8400 and manages to bounce back, things could change. And of course, then the larger question is what happens to the mid caps. And in that, we've been discussing that the trade that got clearly overextended was the tire stocks, and that corrected, and that could continue for some more time. You saw correction in stocks like Motherson, Somi, and Bata, the expensive stocks. The sense you get is that expensive stocks will correct a bit, even if they have to come back to previous highs at some point over the next 3 or 4 months. But for now, booking profits in expensive stocks is not going to hurt you.
Well, I mean, this may only be an academic point, but I'm not able to relate the FII selling to, anything global. Clearly, as you were pointing out, it cannot spook a global sell-off, the Chinese yuan devaluation. It can certainly mean very bad news for commodities for the simple reason that clearly China is admitting that we are very slow in our growth and we are going to use every instrument.
But the point,
so yesterday was it a GST reaction?
The point someone was making, and I don't understand these things much. You are in a better position to understand that. The point someone was making was that this Chinese move on yuan is going to lead to a bit of a global deflation, which is for equity markets always a bigger risk than inflation. That's one point that someone told me.
If you accept this as a sign that China is genuinely worried about its own economic growth and therefore it is using every instrument, interest rates have not helped, reserve requirement cuts have not helped, so it is going to the other instrument to see if that will help economic growth. When it is an admission that there is a slowdown in the economy, then clearly commodities, as you said, is going to take a beating. And if commodities take a beating, then there is deflation.
Yes.
So, that ties in with, what Sonia's point ties in with what you are saying. But for me, I was wondering whether if it is not a risk-off trade that played yesterday, was it an India risk-off that was playing because GST is not getting implemented? Was that, in that case, we have a double whammy?
No,
we not only have money moving out for global reasons, but also...
And I think... for example, the Monday sell-off, was clearly attributable to only the domestic factors. So clearly, right now, it's a bit of a double whammy. But one more point: for last 3 months or last 4 months, we have gone through phases when the market has looked either very ugly, like it's looking right now for last couple of days, or it's looked extremely euphoric, like it looked last week. But the Nifty is only up 2% year to date. It's not moved anywhere. It's been essentially in a range. And this range trading is going to continue with a lot of emphasis on bottom-up stock picking. You're still going to make a lot of money in bottom-up stock picking.
Also, I get a sense the bigger reason for the sell-off yesterday was the way SBI's numbers panned out, because, there was a positive sentiment going into the numbers, and post the numbers, then, the entire pocket, the PSU banking pocket fell. But to that effect, the numbers that we got post-market hours have been positive, whether it was Sun Pharma, whether it was HPCL, whether it was even the India business of Tata Steel that has seen a bit of a recovery. So in that sense, these are a couple of stocks that you should watch out for. I would look out for Sun Pharma more closely, because if you remember, that stock had fallen from 940 to 840 after giving the profit warning. But the numbers yesterday were quite inspiring, especially the margins, which have seen a big up move. So that's one stock to watch out for sure. And the other one is HPCL, because that has been a huge performer this year, and the market is backing, the biggest gainers of the year, and HPCL has seen a big burst in their refining margin.
I am not too sure about Sun Pharma though, Sonia. I'm not too sure about Sun Pharma. I know, a lot of brokerages want to give benefit of doubt and the fact that it's already given profit warning, and that's why, you may want to look at glass half full and only look at operating picture and the net sales. But are these really one-offs? Market is debating that. Yesterday a lot of people were debating that. I am not sure that these Sun Pharma numbers are good enough to take the stock to 900, 950.
No, I don't think that's what she's saying.
That's not what I said. I just said that the numbers are better than at least what the street was going into the numbers.
The sense I got.
That's what I said.
So further selling is not in order, is her point.
No, so I spoke to some people who are large pharma investors yesterday, and they were very worried about Sun Pharma. They believe that there's a good chance that the stock actually breaks the previous low and goes to 750. Could be wrong,
that's a different view.
But it could be completely different.
A different view. My point also would be, whether the market today is in a mood to discount bad news more. If you're in that mood, then Sun Pharma will be taken negatively. If you're in the mood to take it in your stride, you will not. But today, the Bank Nifty could be adversely impacting, and therefore, hurting the overall sentiment as well. Those are more likely than, a very stock-specific reaction. And, now it comes back to me, the ferocity and the seriousness with which Narayan Bagul said yesterday that I'm deeply worried about the Indian banking system, and I think the bad loan problem is worse than the 97, which he saw. At that time, he was a practicing banker, and worse than 89 when he was the biggest banker or the biggest finance expert. So when he's saying that the current situation looks worse than in that, that should make you think. With that, you know, the SBI numbers, refinancing numbers came after markets.
Yes.
So we still have a little bit of reaction left on that.
Oh yes, indeed. And that's, I think domestic sentiment is something that the market has been very worried about. But here's what you'll get to see on the show this morning. The lots of stock talk. Our market master for today is Ajay Srivastava, CEO of Dimensions Consulting. So we'll speak to him about a whole range of stocks and the macros, of course. We have a lot